A lot of people start with the fact they want to buy an investment property, but they don't really understand why they're buying the investment property. What do they want to get out of it? Where do they want to buy it? We work on the end goal. Probably 90% of people out there, it's how do we get the non-deductible home loan debt down? How do we clear that in 4 or 5 or 6 years? How do we use that money more wisely?
Everybody's getting into property to make money, right? I'm yet to come across a single investor that invests in property or shares, whatever, to lose money. Everybody wants to make money. And before I get to the next question, Mark, because I know you're passionate about this, the rent money being dead money.
Yes.
Is that a real thing? The wrong goals can actually take you backwards. The right goals, ones that are specific, measurable, realistic, and tied to your why, will keep you on track, even when things get tough.
It's probably the biggest myth out there that everybody thinks they're on track for retirement. Now, I can tell you right now, probably 95% of people are behind the line of where they should be at their age. If you went out to the street now and asked, most people would know what their net worth is today, which is really concerning.
Welcome back to the No BS Property Investing Podcast. In episode 1, we dug into why Aussies are so gung-ho on property and what's driving that passion. But today, in episode 2, we're going to step back and talk about something that's honestly more important than all of that, your goals. Because property investing without clear goals is like setting off on a road trip with no destination in mind. You'll spend money on petrol, you'll spend time on the road, but you won't know if you've actually arrived anywhere. Today, Mark and I are going to break down what good goals look like, how to avoid chasing false ones, and why getting clear on why will keep you motivated when the journey gets tough. So, Mark, I'm going to kick this one off to you firstly, and I know you and I see this all the time. People walk in wanting to invest, but they can't really articulate their why. So let's start here. Why do you think goals are so critical when it comes to investing and building on wealth through property?
Well, firstly, it's really important to understand where you're going and what you're trying to achieve. So the thing I work with a lot of my customers is what's the end goal? What are you trying to achieve? In the house, we're going to retire at a certain age, et cetera, and then how do we work backwards? A lot of people start with the fact they want to buy an investment property, but they don't really understand why they're buying the investment property. What do they want to get out of it? Where do they want to buy it? When can they buy the next one? Okay, so at ALRC, we work on the end goal, okay? And in most cases, in probably 90% of people out there, it's how do we get the non-deductible home loan debt down? Okay, so say it might be a $600K mortgage on a house worth $1 million. So how do we clear that? Not go to work and, like I spoke about the other day, about catching a train to work every day for 30 years or 22 years, the average loan term, and clearing it and paying the bank a lot of interest, is how do we clear that in 4 or 5 or 6 years? How do we use that money more wisely? How do we get that non-deductible debt down? So it's about the goal, that people don't think that way. That's the goal, is clear the debt. The next goal might be buy multiple investments to get your net worth to a level so that you can work because you want to work, not because you have to work.
And do you think, and I'm a big football fan or sports fan in general, and I almost liken it to people come in, they just say, I want to win the premiership, right? But yeah. There's a lot of work that goes into, there's 18 teams all trying to get to the same goal. Yeah. I guess through property, and I guess would you say this is fairly similar? Like I think a lot of people go through 3 stages, right? Where the first stage is they're renting, and I'll ask you a question in terms of rent money being dead money. I know you're very passionate about that, but they start off, they're renting, rentvesting, and they can't afford to buy where they'd like to live, or they don't know where they want to live yet, right? So they rent, they climb onto the property ladder to begin with. Then the second stage, and sometimes, people are coming to you and I, they're already in this stage. They've got a home with a mortgage already on it, but they sit down with people like yourselves or someone from your team and they go, well, you can be a slave to this for 25, 30 more years, or you can use your borrowing capacity and get this paid off in 5, 10, 15.
Yep.
And then the third one is, oh, great, we've done that. We've still got 10, 20 years of borrowing left.
Yeah.
Now we focus on retirement, right? Whether that's through your personal name or through your super. Would you say that's probably a majority of the timeline where most people...
Yeah, it is. So a lot of people, they might run into a friend or a family member who bought an investment and it sounds like a great idea. Let's go and buy an investment. Or they see a house emotionally and they want to buy the house. Okay, but don't understand the ramifications behind it. So a classic example, say you bought an apartment in Melbourne in St Kilda Road that was under 70 square metres and you bought it in 2010 February. You would have paid probably $750 and the value of today is between $710 and $770. 15 years later, okay? But they were of the philosophy that all properties double in value over 5, 7, 10 years. All properties go up, which is typical for this segment. It's BS.
Yeah.
All properties don't double in value. All properties don't go up. And there's a classic example in a market. So everyone gets caught on that. But what they're doing is when you say goals, I call it strategies. Okay, so why did that person buy that? They probably went down there, saw something nice and shiny. There's a nice display down the bottom. A building's about to go up. It's brand new. And they got caught up with it in the moment. And now 15 years later, if they put that asset into 4 or 5 different markets, could have been Queensland, could have been Adelaide, could have been Perth, could have been regional Victoria. It could have been all these different markets in that time, and they could have tripled their money. But they've chosen to go down that emotional path. Okay, and that's all because they didn't have a strategy. All the strategy was, gee, I like that. The Australian dream is to buy the house we spoke about last time, and or buy an apartment or get ownership of a property and then purchase the asset with minimal stamp duty because the salesman pitched that to them. So the problem is they haven't got a strategy or the goal in mind when they made that transaction.
And I guess kind of referencing it back to football, like everybody's getting into property to make money, right? I'm yet to come across a single investor that invests in property or shares, whatever, to lose money. Everybody wants to make money. Mm-hmm. Everybody wants to win the premiership when they pull the boots on. But you talk about strategy, they've got to have a game plan to win.
Yep.
They've got to have the players to win, and that's what's so crucial in that property space. And before I get to the next question, Mark, because I know you're passionate about this, the rent money being dead money.
Yes.
Is that a real thing?
Absolutely. All
right, so let's get into some myths here, Mark,
yes.
because you touched on some property doubling in value by the shiny new apartment. What's some of the most common false goals or narratives that you encounter on a daily basis?
Well, probably the biggest one is rent money's dead money.
Yep.
Okay.
The Aussie home loans guys, I remember his ad even as a kid, rent money is dead money. That's where it came from.
You sound like him. So he got it wrong completely. But he's a home loan provider. He's Aussie
that's
home
right.
loans.
That's right.
He's a mortgage choice, an Aussie, a home loan provider, not an investment strategist.
Yep.
So they aren't going to know that, and that's fine. That's their market they play. But rent money, there couldn't be anything truer. I could show you 50 out of 50 cases that show rent money isn't dead money because the opportunity is going to cost less to run, and the chances are where you're not buying emotionally, the growth in that opportunity is greater than the one that you're going to buy emotionally. So that proves that myth. Other myths out there in regard to, I just want to pay my house off and go to work every day. I just want to clear my home loan debt.
Yeah. Would that be, because it's a good one, I know you'd be drilling down this with your clients as well. It's like, well, I'd rather just put in an extra $100 or $200 a week in my rent. Is that going to get them, they go, I don't want to buy another property, even though I can afford it. I want to just do that extra $200.
There are people that are scared of debt or don't understand debt.
Yeah.
Or don't have the risk profile of the upbringing or the comfort level to actually borrow money, but not really understand how debt runs.
Or do you feel also too that they think that extra $100 is going to shave decades off, or realistically it's only going to shave, maybe 5-10 years, where the investing in 1 or 2 growth assets might shave legitimately decades, right?
Exactly right. So we actually educate our clients to own their house in 4 to 7 years. So how to use their debt properly, getting that non-deductible debt down, getting the deductible debt higher. And then how do we clear that and exiting certain strategies to actually clear that non-deductible debt because it's so expensive to run. But you're right, just paying extra money, it's a long road. It might take your loan term from 30 years to 25, and that's a long time to be going to work every day.
Yeah.
And the net worth we need to be worth these days to retire. Okay, if you're paying your house off at 55 and you want to retire at 60, you've only got 5 years to clean that up, and you need to own a lot more than your house. So to me, that's a strategy that's not great and is definitely a bit of a myth.
Yeah, and I guess so. Another myth that I feel is, cash flow positive or passive income kind of happening overnight, which gets into my next question in terms of, I really think that people underestimate how long wealth creation actually takes. Like, what do you think is a realistic time frame for someone serious about building a property portfolio, or let's call it creating wealth through property?
It definitely takes a long time, and the earlier the better, because there's all various markets. Okay, so like if you bought in the apartment market in 2010 in Melbourne at under 70 square metres, you've made nothing over 15 years. Okay, so that market will change at some stage. I'm not saying when.
I don't know if they'll make money in the next 15 years, if I'm honest.
So the apartment market's going to move at some stage, but that's a market. So the earlier the better, okay? Paying a house loan, a 30-year loan term, it's a long term. If you're getting your first house at 30 years is 60, you want to retire at 60, it's done.
Well, I think the average age when I had a look at this lately was like 38 or something at the moment, right? So
to get a house loan.
Yeah. So you're past retirement.
So technically you've got 22 years. You're past retirement on the 30-year loan term. So if you're not doing other things at the same time. So we look at owning assets between 4 and 7 years, investment properties, and try to use experts like Ripehouse to know when to buy and what to buy. Yeah. So there's 7 years. And if you want to own, I think I bought my 40th property going back the other week. Don't own 40 now, but I bought my 40th. I wish I owned 40. And I've been doing it since 21. Okay, so I've been going over 30 years. Okay, so if each asset is like 4 to 7 years, and then your home loan's 22, say a 30-year loan term that you bring down to say 15 years to clear it, and you can do it a lot quicker if you do it well and strategically. So it is a long-term thing. It's a long-term play, but property's never been a short-term play. Okay, no one out there saying go and buy a house and sell it in 2 years' time. We have seen some markets like Sydney over 2 or 3 years double in value. We've seen a few like in Perth, south of Perth, Bunbury, Mandurah, Rockingham did about 95% growth in under 3 years. So we have seen it every now and then, but very rare.
Super rare. We've had clients who have invested in some of those hot markets over the last previous years, and they'll always come back like, oh, let's do something exactly like we did last time. I'm like, guys, this is a potentially a once in a lifetime phenomena. Like if you've got an investor in front of you and you're turning around and saying, hey, we're going to get 7 or 8% each year for the next 20, 30 years, which we don't guarantee anything like that. But if you got that, I guess seasoned investor knows that would be a great.
Their expectations are growing, haven't they? And they've seen the rewards of that, which is great because that gets them into the market to do it. But I look at it, if you're making 35 to 40% growth over, say, 4 to 7 years, you've won. Okay, and the running cost to run that, you're trying to get around the 1% mark.
Yep.
So after rent, after expenses around rates, maintenance, management fees, insurance, water, tax refunds, depreciation, if you can get your cost around that 1% and you're buying an asset for 600K at 1%, $6,000, hold it for 5 years, that's $30,000 holding cost. If you're making 40% growth, it's very worthwhile.
Yeah, and I guess looking at kind of bigger picture, if you're getting 5, 6, 7%, whatever it might be per year, and inflation hovers around at 2.5%. Yep. Your net wealth is just getting further and further ahead, and the larger your asset pool is, that's what's going to expedite or in some cases slow down reaching your goals, which I think...
When you say larger, that's the leverage effect. So if once that home loan debt gets down, so you sell X and Y, get that home loan debt down slightly, that creates more equity here to leverage further. So then you get a bigger asset base. And if you're pulling that 7 or 8% on average against that asset base, then you're going to be in good stead.
And I mean, touching on goals a little bit more there and almost myths as well, because I think Rentvesting, which you're passionate about, I'm passionate about, but I think it's obviously getting more and more popular out there. Do you think people need to, whether it's a myth, whether it's a realistic or your goals in Rentvesting, do you feel, I see there's a bit of a trap in the market at the moment where people are getting into Rentvesting, maybe they can afford to, but they don't want to take on such a massive mortgage. So they're living in Melbourne or Sydney, they don't want to have $1 million or $2 million mortgage. So they go buy an investment, but they buy that one $500,000 investment, they feel like they've ticked the accomplishment. Yeah. Do you feel like that's something where people maybe aren't realistic enough at the moment, where that, like, if you're going to buy, I'm of the view of if your goal is to buy $1 million house, you should have as close to or more than $1 million worth of investment properties, right? Do you have a similar thought on that?
From the banking perspective, it's more to me about the cash flow and the running and the risk profile of the customer. How does the customer sleep? What kind of home loan debt can they have? Okay, so I can kind of judge that pretty quickly in a meeting. If they're on $250K joint income and they can afford payments of, I don't know, $4,000, $5,000 a month, that would equate to a loan of $650K, call it. Call it $4,000 a month. Call it a $700K loan, which means they need to be worth $300K plus the cost to buy. Cost you $60 to $80K to buy. They need to be worth $380K before they do that. But the calculator at the bank will tell you they can borrow $1 million. Let's go and do it. And this is where the whole system, the Royal Commission didn't sort this out. Okay? Because the banks will just keep lending off the calculator. So I very rarely, and we don't educate our team to actually read out a borrowing capacity and tell a person what their maximum capacity is, because I actually think it's BS. Okay, we should be understanding the client, what we're doing, where we're going, what are their goals, what's their debt level, what pressure do they like, are they going to maternity leave, are they going to one income, is their job secure, okay? And then you have a percentage of their income used to run an investment to look at clearing that investment and exiting that investment to clear this home loan debt, to release the pressure to get that payment from $3,500, $4,000 down to $2,000. And then we upscale from there. They're my thoughts around that.
Yeah, but I guess, do you see the risk that person runs where, their goal is the $1.5 million house they can buy, but they've bought the $500,000 asset that they're trying to close? I guess that's why.
There's two sides to it. You don't want to go and get that because the computer says you can borrow that. You shouldn't do it.
Yep.
Okay, so big advocate against that.
Yep.
But at the same time, I hear, so say it's a lesser figure, they don't invest enough and the asset they could have bought actually generates X worth.
Runs away from them almost.
Yeah, runs away from them. Runs away from them. And then they didn't invest enough. So that's about getting the best advocate out there, okay, and talking about the data in regard to what's going to outperform the asset we were thinking about buying. So that's what that bit comes down to.
Yeah.
So you've got to ensure that what we're buying is going to outperform the one that we were going to buy.
Yep.
And potentially, hopefully, cost less, which it should if it's negative geared.
Yeah, because I feel whether it's a generational thing, that it's become the new, we talk about the older generations paying off the mortgage, that's their goal.
Yep.
And they put the queue on the rack and they've not really focused on retirement. I think the current generation's goal is, well, I want to rent because I want to live, in Toorak or wherever it might be, but I'm going to invest. I invest a small amount and they're just kicking the can down the road, and that the gap between the property they could have bought versus what they invested in will actually get bigger unless, because I guess no wealth creation's made, would you agree, unless there's some kind of sacrifices, right? Whether you're going to be diligent on your savings, you've got to make some kind of sacrifices.
Yeah, in most of our cases, our customers will say, look, let's sacrifice living and buying that house and having a 900 mortgage now, okay, where we can't touch it and feel it. Let's go and get these investments working harder, get our net worth to a level, and then come back to that place when the home loan debt's at a level that you should be looking at. That's definitely a strategy we use a lot with our customers. Don't, just because we can borrow that, doesn't mean we should borrow that. Just because the bank says you should do it, they love you doing it, by the way.
Yeah.
They want the interest on that loan for the next 30 years and they make $1 million. Okay, this is how they make billions of dollars.
Yeah.
Okay, but I'm a big advocate that, again, like I mentioned previously, your non-deductible debt's got to be low. You've got to time how much you get into. You've got to have an exit strategy to get out of it. And it shouldn't be paying it off with an extra $100 a fortnight for the next 25 years.
Yeah. Yeah.
But one of the other things we just mentioned before, just reminds me of in regard to myth busting, is that everybody out there believes that they can retire, that they're on track for retirement. And that's probably the biggest myth out there. Okay, no one knows what their net worths need to be. And we've just built an app called Lolly that we're rolling out at the moment that actually is going to tell you your retirement age and your net worth and what income you need to have for that. And that's probably, talking about, I missed that one before, it's probably the biggest myth out there, that everybody thinks they're on track for retirement. Now, I can tell you right now, probably 95% of people are behind the line of where they should be at their age.
I was going to say, I'd probably say maybe 5% of the people I deal with are probably on track to reach, because they just don't make, I guess, those sacrifices with realistic timeframes on their goals.
Well, they don't understand the actual net worth. So if you went out to the street now and asked, most people wouldn't know what their net worth is today, which is really concerning. So if they don't know what their net worth is today, how do they have the goal or strategy to get to their end goal when they don't even know what that number is? So that's probably the biggest myth out there that we're probably trying to assist clients with understanding more.
Which, tying that into the next question as well, which I think we talk about emotions versus logics. Do you find some people get caught up in the emotional side of investing or ego side, where they want to come out and say, oh, well, I've got 5 properties, even if the numbers don't actually make sense, or I wouldn't want to invest in this location because I don't want to live here, or I can't, I'm not liking that floor plan. Do you feel that's a bit of an issue for people?
Been an issue since day one.
If you're serious about building wealth through property, you don't just need a loan, you need a strategy. And that's exactly what the Australian Lending and Investment Centre delivers. Australia's most awarded brokerage. They're not just looking at what you can borrow, they'll build you a holistic lending plan tailored to your long-term goals. We use them, we trust them, and so do our clients. So to find out more or to book your complimentary lending strategy session, head to the link in the show notes to connect with the team. Thanks for listening. Now back to the video.
So we set up the Investment Lending Centre at ANZ probably 22 years ago. And ALIC's going about 15, 16 years. And that's been the whole stories in regard to, but I don't want to buy that. And the answer really should be, and this is probably coming from you more than me from a lending perspective, is that you don't need to like it. Okay, it needs to make you money. I've made more money out of most of my investments, of the ones that I don't like, because I'm not emotionally attached. I'll make an exit strategy out of it. I'll sell it when I need to sell it. Okay, there's no emotion when buying it. I won't overpay for it. And that's where people get caught. They overpay because they get caught up and they think their understanding of what property they would like is going to perform. And in most cases, it's not.
And do you feel also too, it ties it, because my most unique one is, well, we can't invest in that house because there's no side access. What if somebody's got a boat or a caravan? They couldn't possibly invest in that one. But I think another one might be that, do you feel it's sometimes the ego gets in the way where they want to be at the barbecue or the dinner party and say, well, I've got X amount of properties, regardless of what they're actually worth. Yeah. Or they want to be able to say, well, yeah, I invested in the Northern Beaches or Bondi or Brighton or whatever it might be. That's another ego side that you see. Yeah,
everyone likes to brag a little bit, I think. It's part and parcel of the average Australian, isn't it? But But that's not the reason we work with our clients. We're working with our clients to change their life and to educate them and to get their money working properly and to be strategic and to clear the non-deductible debt and set themselves up for life so they can make decisions. I wouldn't have said it's probably out there. You probably see it more from your perspective with customers that come through to Ripehouse, but through LRC it's probably not as prominent.
And this one, this next question I've got for you ties a little bit into myths and realistic goal setting, but another reality check I feel for a lot of people in general, whether it's to buy a home or for investment, sometimes the bank just won't lend what people want. So what happens when someone's goals are bigger than their borrowing power? Like, what do you do with a client in that regard?
Well, you get to the bottom of it all as to why they want to buy the particular asset or borrow the certain money and explain to them how it all works. You show them how the banking system works and why they have restrictions and why they have servicing rates today at 8.4 and 8.8 for investment, and why they have to protect, how we have to protect the economy and make sure that we don't get into a situation we're going to recessions and those types of things. So the way we manage it is really get down to the root cause. What are you trying to achieve? What is the end goal, which we spoke about earlier? Okay. What is your strategy? Okay. Because normally those people just have an idea that I want to buy this investment. I've seen it. I want to borrow this. I want to own 3 houses. I want 1.5 million. And they don't understand the consequences of how it runs. What if rates go up 18 times? What if your tenants leave? What if you lose your job? What if your wife goes on maternity leave? Okay, they haven't thought through that. So we strategically lend, and I think brokers should strategically lend, bankers strategically lend so that customers understand that. That's our role in the economy out there, to actually get out there and make sure these people aren't making those errors or mistakes. So it's not about finding a way around it. In most cases, it's not trying to find a way around it. It's actually trying to deliver a better strategy that's more suited to them for their current position that they're in.
And I think it's part of the ALIC, Australian Lending Investment Centre's ethos is that ethical lending side. I guess one of the bugbears that I have at the moment, and I've got LinkedIn and I like to jump on there and read just some stuff. And there's a lot of brokers out there really driving home this 5% first home buyer scheme, where from my side of the fence, I actually think the ethics side of that, when you're telling a young couple who are naive, they don't have any, whether it be financial literacy or whether it be about much scope about property, some of these people are going out there buying a $1.5 million apartment in Sydney, which won't grow or will grow, but basically at the rate of inflation, if that. Yep. And then they're going to go take on debt that will
1.3 million.
1.3 million or more of debt.
Yeah, 10 grand a month.
Yeah, that's what I mean. So they become a slave. So I think there's that, you're right, there's that ethics side to it as well.
We're just a big firm believer that you lend to enable wealth. Okay, which is quite rare from a broker. There's a place for those brokers out there, and there's a place for those customers that need that. I agree. But what is stopping those customers putting themselves into that financial stress? And we were hoping the Royal Commission would come out with a lot of that, but it really hasn't hit the mark. So there's people that go into banks right now, even though servicing rates have gone up to 8.3%, and people are borrowing that money, $1.5 million. So I feel sorry for a lot of those people in Sydney, in that market at the moment, that are under the pump for a long, long time. And it stresses that they don't have to take on if they thought about it differently, if they went rentvested, and they're going to say that the rent's high, but it's not as high as $10,000 a month.
Yeah, that's right.
Okay, it's not even close.
No.
Okay, it's probably half that, or $6,000 or $7,000. That's $3,000 they could put towards other ways, and that's $3,000, which is $36,000 a year, which is quite a bit. And they could invest that into other assets or growth assets to look at ways to create wealth to enable the debt reduction of that home loan debt to reduce the pressure. So there's that happening, but there is a place for those out there. I know you said you get frustrated in regard to on LinkedIn and seeing all these types of things out there, but there's a market for it. But our challenge is, Julian, how do we get to more people to actually educate them better so they don't get in those situations?
Yeah, absolutely. If I could change one thing, which I definitely don't have the power to do, it would be that I'd love to see banks disclose, rather than just repayments, what it actually takes out of your salary from your gross salary. Because I think people look at this little figure, or it's not so little, but $6,000 or $9,000 or $10,000 a month, and they go, well, I make $300,000 or we make $200,000. They go, well, it's not that much. Yeah. But when they actually saw what it was actually taking out of their salary, that would be a big one. The second last question I've got for you for today, Mark, is more about reviewing goals, because I'm a big believer of this as well, that life changes. Kids, jobs, health, interest rate rises, they can all kind of throw somebody off course and from pillar to post. So, how should investors how often should they be reviewing their goals? Like, do I just come to my accountant or financial planner or a broker when I'm ready to buy? Do I do it every month? Do I do it every quarter, every year? Like, how often should we be reviewing our goals?
Well, to review, firstly, you've got to have a team. Yeah, so that's a big problem. Probably 95% of people don't have the right team or don't have a team or don't have the right team around them. So first of all, getting the right team. And then reviewing it, I catch up with my clients every 6 or 12 months, depending how often they want. Some people will put it out to 2 years, which they probably shouldn't because the market changes a lot. Okay, rates change a lot, which is 18 rate increases in, what do we have that over about 2 years or a bit under 2 years? So things change drastically through there. So it depends on the market, what's going on. But say every 6 months or 12 months, we should be having a strategy conversation in regard to your structures, in regard to your cash flows, in regard to your savings ability, your cost to run your assets, okay, and what options you've got and what's happening out there. And then on top of that, they should be catching up with the buyers over at like Ripehouse to talk about the actual individual properties and the actual individual strategies on each of those properties and the exit strategy around that, okay? And that's probably, that's more for you, but that's probably a yearly thing for you. The lending side from cash flows, tax, income, borrowing capacity is probably a 6 monthly thing for us. So it's horses for courses. But that's my belief, and that's I touch base with every one of my customers every 4 months with an email saying, I'm here. If you want to talk strategically, let's catch up. And then we probably get the take-up rate probably, on average, probably every 9 months.
Yeah. And I guess that's because, too, people's relationships change, their income changes, potentially they've offloaded a property, inherited money. There's all these different factors that come into it. And then also, too, I think we have a bit of a mindset that we can never sell a property, right? We've got to hold on to it forever.
The Australian dream.
Yeah, that's it. We've got to hold on to as many. We're hoarders. But sometimes, too, it can be, well, we have this review, we look at a market. Well, maybe it's not necessarily that we think that the market's going to go backwards. But sometimes, too, it's we could actually pay this home loan off if we offload this asset.
Well, there's a myth. All properties go up, yeah? All properties double. And this is your domain, but I could talk about 5 markets in Australia that haven't doubled in 10 years or haven't gone up in 10 years.
Yeah.
At various times. So there's another myth right in front of you.
So for the last question I've got for you for today, Mark, in terms of personal reflections, so we'll make this one a bit more real.
Yep.
So I guess, Mark, what are some of your personal financial goals these days? And I guess, have they shifted over the years?
Shifting all the time. Okay, so mine's very different today to what it was 3 years ago when I was married. The strategy obviously at the moment was to time exits and make sure that my personal investments actually go through their cycle and then offload those assets at certain times to ensure that the family was still a family, is looked after and kids are looked after and ex-partners looked after, et cetera, et cetera. So mine have changed a lot. If I was not in a situation of going through separation over the last 2 or 3 years, I would have been buying a lot more in the last 2 or 3 years. But just before, I think I bought 7 properties in a year. So we got pretty active probably 3 or 4 years ago, knowing what the market was doing. But right now, I'd be investing right now if I could, and we'll get back into the market shortly as soon as I can. But it's changed massively. From 21, it was buy as many as we can, leverage up. But it's not a speed thing. Like we said earlier, it's not a speed thing. You don't build Rome overnight. You do it slowly, and you do it systematically, and you do it within your profile and your cash flow and your buffers, and ensure you have income insurance. So you minimise risk in so many different ways. So we carry about 4.7 billion in loans at ALRC, and we hardly have a loan in arrears, which tells me all our clients have buffers, they're sleeping at night, they're comfortable, there's no real alarms, and that's after 18 rate increases.
So what you're telling me, Mark, not a lot of 95% loans going out the door at ALIC for first home buyers?
Not a lot. We'll still do them if customers come to us and want to be an investor, okay, but that's more brokers under me that will actually look after. There are a lot of it, I love looking after customers and saying that, Julian. Customers who come to me are 22, 23, driven, motivated, 60 grand, want to buy their first investment. Those people will be on 200 grand within 4 years or 5 years, and they'll have 5 properties. Yep. And they're set up. So we don't discount those, but they're absolutely fabulous clients and long-term customers. Where a lot of brokers will probably look at that and go, I don't want it, it's a small loan.
Yep.
It's a lot of work. But we actually see the gold in that type of customer. But yeah, so first homeowners, not to buy the house, but maybe the first property owners is a better method.
Yeah. Awesome. Well, thanks for today, Mark. I guess to wrap it up, the wrong goals can actually take you backwards. The right goals, ones that are specific, measurable, realistic, and tied to your why, will keep you on track, even when things get tough. So if you're listening and your goals feel a bit vague, that's okay. Start small, get clear, and don't be afraid to adjust along the way. Mark, thanks again for your insights today. And for our listeners, we'll have the links in the show notes if you want to sit down with us and map out your own property goals. That's it for this episode of the No BS Property Investing Podcast. We'll see you in episode number 3.